Welcome to The Explainer. Today, we're looking at something pretty wild, a highly contrarian move in global capital. It's a fascinating look at how one nation is just completely rewriting the rulebook on foreign investment, basically throwing conventional wisdom right out the window. So if you're interested in macroeconomics, capital flows, or emerging markets, you are definitely going to want to pay close attention to this one. So think about this. What actually happens when a country plays hard to get with foreign capital? I mean, usually, especially for developing nations, right, they're practically bending over backwards. They're offering massive tax breaks, crazy incentives, just begging for foreign money to cross their borders. But Zimbabwe, they are taking the exact opposite approach, and they're rolling out a strategy that literally has the entire global financial community buzzing. Okay, let's dive into this. To get why this is such a massive gamble, we got to look at the big picture of the African investment landscape right now. We are currently sitting in an era of slower global growth, much tighter liquidity, and frankly, heightened geopolitical fragmentation. Capital is incredibly scarce. It's this hyper-competitive environment where every single country is fighting tooth and nail for the exact same shrinking pool of foreign direct investment dollars.
All right, part one, the $20 million velvet rope, also known as Statutory Instrument 215.
Picture the government of Zimbabwe essentially acting as a very strict VIP bouncer for foreign investment. They are deciding exactly who gets in the club and who stays out on the street. They've just introduced Statutory Instrument 215 of 2025, which brings in these super aggressive new indigenization and economic empowerment regulations. What this does is violently shift the economic landscape in Southern Africa. It enforces these incredibly strict capital and employment thresholds, really clamping down on foreign participation across key reserve sectors of their economy. And they've already begun actively enforcing this, sending absolute shockwaves through the market.
And here is the sheer magnitude of the cover charge we are talking about. $20 million. No, that's not a typo. If you're a foreign investor and you want to participate in Zimbabwe's retail and wholesale trade, that is the absolute minimum capital you now need to commit. Just to get your foot in the door, it completely, utterly changes the calculus for entering this market.
But wait, it doesn't actually stop at just the cash. 200. That is their secondary requirement. It's an immediate mandate to employ a minimum of 200 local workers. So you need that staggering upfront capital, plus you need guaranteed local job creation right from day one.
Now, what's really fascinating here is how this barrier to entry slides up and down depending on the specific industry. It's not just a lazy blanket rule, right? It's a highly targeted sector-by-sector filter. Look at grain milling. You need a massive $25 million and 50 local jobs. Haulage and logistics, that's 10 million and 100 jobs. Shipping and forwarding, the barrier's a bit lower there, but still a very significant $1 million and 20 employees. This isn't random at all. It's a very calculated move to extract maximum value and employment intensity from their strategic sectors.
Moving right along to Section 2, reserved for local citizens, the exclusions.
So, what about the everyday businesses that aren't on that multi-million-dollar VIP list? Well, this is where the policy puts up an absolute brick wall. Certain sectors are now 100% walled off from foreign money. We're talking barbershops, employment agencies, bakeries, advertising agencies, artisanal mining, local arts and crafts distribution, beauty salons, and borehole drilling. The government is aggressively protecting these everyday consumer and local service sectors to make sure they stay entirely in the hands of indigenous operators. Now you might be wondering, what if you're already a foreign operator? Say you've been running a successful bakery or an ad agency there for years. Well, tough luck. You are not grandfathered in. You suddenly face this massive compliance hurdle with 3 incredibly strict steps. Step 1, you identify if you fall into that restricted sector status. Step 2, you have to dispose of 75% of your shareholding to Zimbabwean citizens. And step 3, actually the hardest part, you have to complete this full transition within a strict 3-year period. As you can see, under this forced shareholding disposal, a massive 75% slice of the pie must go to Zimbabwean citizens. Foreign ownership is permanently capped at a maximum of 25%. It is a dramatic, legally mandated reshuffling of equity. It fundamentally alters the whole concept of ownership security for any existing foreign businesses in those categories. Which brings us to Section 3, filtering for the big fish. So why do this? Why risk scaring off investment when money is tight globally? Well, the government is intentionally trying to completely overhaul their investor profile. They are pivoting hard away from small-scale speculative operators or diaspora-backed enterprises.
Basically, the folks who simply don't have $20 million lying around and will obviously be discouraged by this. Instead, their explicit target is the whales. They want large, institutional investors capable of delivering major infrastructure and serious long-term capital deployment. Zimbabwe is explicitly saying, we prioritize economic sovereignty and massive scale over broad-based, small-scale foreign participation.
And there's a really fascinating tension here, right? Because officially, government officials are still actively out there repeating this mantra, Zimbabwe remains open for business. The official PR narrative says the doors are wide open for foreign capital, yet the reality on the ground is this highly restrictive velvet rope environment with incredibly steep financial and employment thresholds. So it's open, but only if you're a very specific type of VIP guest.
Let's zoom out a bit for Section 4, the regional ripple effect. To really grasp the weight of this policy, we have to look at the neighbors. This whole strategy stands in absolutely stark contrast to the broader trends we're seeing across the continent. While Zimbabwe is enforcing restrictive access, strict job thresholds, and required capital minimums, their direct competitors, places like South Africa, Rwanda, and Kenya, are doing the exact opposite. They're expanding investment promotion, throwing out industrial incentives, and creating totally open infrastructure financing to attract multinational capital. So while the rest of the continent is aggressively throwing the doors wide open, Zimbabwe is over here installing a $20 million deadbolt. So, the crucial point to take away from this explainer today is this: Zimbabwe isn't totally closed. For global investors, yes, the consumer sector entry costs are undeniably astronomically higher now, and sure, serious questions remain around long-term policy predictability. But massive opportunities still remain in sectors like mining, energy, and heavy industry. The government is essentially playing a high-stakes game of gatekeeper for their consumer markets while still aggressively hunting for that heavy industry capital.
Which leaves us with the million, or rather the $20 million question. Will prioritizing sovereignty over broad foreign participation actually attract these whales, or is it just going to drive them to friendlier waters? Analysts and institutional investors worldwide are watching this very closely to see how these ownership rules actually play out in practice. It's a massive economic gamble, and honestly, only time will tell if playing hard to get pays off. Thanks so much for joining me for this explainer. Keep questioning, keep learning, and I'll catch you guys next time.